In 1973, Americans waited in line for 3 hours just to fill their gas tank. Inflation had hit 14%. Jobs were vanishing overnight. The stock market had crashed 45%. The U.S. economy was in complete freefall. It took America nearly a decade to recover from that crisis. Today, I am going to show you 6 data points, real numbers, from real institutions, that prove we are closer to repeating that disaster than anyone is willing to admit. My name is Joe and this is Real USA Finance, where we give you the truth about the U.S. economy that mainstream media will not. Data point number 1. Oil just hit $108 a barrel. That is the highest price since July 2022, and it happened almost overnight because of the US-Iran war that started on February 28th. Here is what most people do not understand about oil prices. Oil is not just gasoline. Oil is in everything. The plastic in your water bottle, oil. The fertilizer that grows your food, oil. The fuel that ships your Amazon packages, oil. The electricity that powers your home, oil. Goldman Sachs, one of the most powerful banks in the world, just updated their forecast. They expect Brent crude to hit $115 a barrel in April. That is not a prediction. That is a warning. In 1973, an oil shock triggered by the Arab oil embargo destroyed the U.S. economy for years. Today, a war in the Middle East is doing the exact same thing, except this time, nobody is talking about it. Data point number 2. The OECD, that is the Organization for Economic Cooperation and Development, one of the most respected global economic bodies in the world, just released a bombshell forecast 3 days ago. They are now predicting U.S. inflation will hit 4.2% this year. Let me put that in perspective. The Federal Reserve, America's own central bank, said inflation would be 0.7%. The OECD just said it will be 4.2%. That is not a small difference. That is a 55% higher forecast than what the Fed is telling you. And why is inflation going so much higher? Because of oil, because of tariffs, and because consumer confidence has already dropped to recession levels. Exactly what happened in the 1970s. When inflation is this high and rising, families start spending less, businesses start hiring less, and before you know it, the economy starts contracting. That is the beginning of stagflation. Data point number 3. The S&P 500, the most important stock market index in the world, has fallen 6% in the last 30 days. The Nasdaq, which is mostly tech companies like Apple, Nvidia, and Google, is already in correction territory. That means it has dropped more than 10% from its peak. Now, some people will say, stocks go up and down. This is normal, and they are right. But here is what is different this time. In a normal market downturn, the Fed rides to the rescue. They cut interest rates. Cheap money floods and stocks recover. We have seen this happen again and again. 2008, 2020, 2022, but right now, the Fed cannot cut rates because inflation is rising. If they cut rates, inflation explodes higher. If they raise rates, the economy crashes harder. They are completely trapped, and that means there is no safety net for this stock market fall. Data point number 4, and this one is the one that should scare you the most. Warren Buffett, the greatest investor who has ever lived, has one rule about the stock market. He said, if the ratio approaches 200%, you are playing with fire. That ratio he was talking about is called the Buffett indicator. It measures the total value of the entire U.S. stock market versus the size of the entire U.S. economy. When stocks are worth roughly the same as the economy, that is normal. When stocks are worth way more than the economy, that means stocks are dangerously overvalued. Buffett said 200% is where you are playing with fire. The Buffett indicator is currently at 213%. That means the U.S. stock market is valued at more than double the entire U.S. economy. Even Buffett himself has called this playing with fire, and we are already above his danger zone. The Shiller-Pay ratio, another respected valuation measure, is also near 40. Its long-term average is just 17. The last time it was this high was right before the dot-com crash in the year 2000. Data point number 5. While the stock market is at record valuations, the actual U.S. economy is slowing down fast. U.S. GDP, that is the total size of the American economy, grew at just 0.7% in the fourth quarter of 2025. To put that in context, healthy U.S. growth is around 2 to 3%. We are at 0.7%. Government spending fell 5.8%. Exports dropped 3.3%. Consumer spending is slowing. This is exactly what the 1970s looked like. The economy was slowing, but prices were still rising, stagflation, and now the OECD is warning. Concern about both inflation and unemployment are moving up. together for the first time since the 1970s, when GDP is this weekend, inflation is this high at the same time. History tells us what comes next. It is not pretty. Data point number 6. The last line of defense, the Federal Reserve, is frozen. On March 18th, just 11 days ago, Fed Chair Jerome Powell held interest rates steady at 3.5 to 3.75%. This was the second pause in 2026. The U.S. economy lost 92,000 jobs in February. That is the worst job loss since 2020. Normally, when jobs disappear like this, the Fed cuts rates immediately to rescue the economy. But they cannot, because oil prices are surging, because the OECD just said inflation is going to 4.2%. If the Fed cuts rates now, inflation could go to 5, 6, even 7%. Bank of America's chief investment officer described the Fed as walking a fine line between its goals. Markets are now pricing in zero rate cuts for all of 2026. Zero, the Fed's only tool, gone. So let me bring this all together. Oil at $108, heading to $115. Inflation forecasted for 0.2%, nearly double what the Fed predicted. The S&P 500 falling 6% with no Fed rescue possible. The Buffett indicator at 213%, above Buffett's own danger zone. GDP growth collapsed to 0.7%, and the Fed completely frozen, unable to help. Now, I want to be honest with you. This does not mean a crash is certain. Goldman Sachs still says a recession is not their base case. Deloitte projects GDP will grow to 0.2% for the full year. The U.S. economy has survived worse. But what these 6 data points tell us is this: the risk is real, the warning signs are flashing, and the smart move is to prepare now, not after the crisis hits. In my next video, I am going to tell you exactly what to do with your money right now, which investments protect you, which ones to avoid, and how everyday Americans can survive and even profit from what is coming. If this video gave you value, please subscribe to Real USA Finance and hit the bell icon so you never miss an update, and comment below which of these 6 data points scared you the most. I read every single comment. This is Real USA Finance. Stay informed, stay ahead.